So let's look at setting up a covered call on a trade page. Different trading platforms, so not to worry. This one's just easier to read for these examples. So in this case, what we're going to do is we're going to look at SPY stock. And the reason we're looking at SPY stock is because this is the S&P 500. This is that benchmark we looked at when we talked about mutual fund managers. So you could have just bought this stock, held on to it for 10 years, and outperformed 95% of the mutual fund managers out there. But hopefully we're going to do better than that doing covered calls. So at this point, the stock is selling for $215.99 a share. So if I buy one share, it's going to be $215.99. But what's our rule number one when we're talking about covered calls? We have to do it in blocks of 100. So 100 shares of stock is just going to be $215.99 times 100, which means it's going to cost us $21,599 in order to buy 100 shares of SPY stock. So that's our first rule. What's our next couple rules? Well, we want to sell a call with a strike price above the stock price and about 30 days away. So let's see. So here we are. Here's a trade page. $215.99 is the current price. 32 days away is where we're at, so roughly a month. And here's the 215 call. With our rules, are we allowed to sell this call? Of course not. 215, our strike price is below the stock price. Remember our rule, it's got to be above. So this breaks our rules. We cannot sell this call. So how about the 216 call? Does that fit our rules? Well, it does. It's close, but 216 is still above 215.99, so this is a perfectly good call to sell. It meets all our rules. Strike price is above the stock price, and we're about 30 days away from expiration, in this case 32. This is a perfectly good call to sell in order to set up a covered call scenario. So when we sell this 216 call, how much do we collect in credit? So when we sell this 216 call, we're actually collecting a credit of $290. Okay, that sounds pretty good. So what are our other options? Can we sell a different call? Sure, we can sell the 217 call. We can go one higher. And what happens then? Well, you see we collect a little bit less. Now instead of 290, we're only collecting 229. All right. Can we keep going? Can we do even more? Sure. We can go to the 218 call, and you can see as the calls get higher, our credits continue to get less. So we started at 290, at 216, now we're at 218, and we only collect 173. So what happens if we go way far away from the stock price? Let's go all the way up to 222 as our strike price. Well, now we're only collecting $33. So surely there's got to be a best case scenario, right? I mean, in one we collected 290, we go way out here, we're only collecting $33. So how do we choose what call to sell, right? I mean, there's so many options. How would we pick one over the other? Well, we use it doing three criteria. We're going to look at cost basis. How low can we go? We're going to look at POP, which is the probability of profit. And the probability of profit means what's our probability of making at least $1 profit on this trade? That's the definition of probability of profit. What's the probability of making at least $1 profit on this trade? And finally, we're going to look at ROR, which is rate of return, which is a profit potential broken down into a percentage. What kind of percent return can we get on this particular trade? So those are the three criteria. Let's start breaking them down and seeing why we choose one over the other.